Thanks for joining us today on Market Call. I'm Morella Fernandez. James Telfser with us on the show, partner portfolio manager, Ewing Morris Co Investment Partners. He'll take your questions today on North American stocks, and here's how to reach us. You can call us toll free, 1-855-326-6266. You can also email your questions, Market Call at BNNBloomberg.ca. James, thanks for coming in.
Yeah, great to be here.
Okay, let's talk a little bit about trade threats that are still sort of hanging around because of Beijing and Washington getting into it a little bit last week. But you're seeing markets rebalance. What have you noticed?
Yeah, I mean, we've seen this since April. There's been some ups and downs on the trade front. So it's hard to not look to that prior playbook and look forward and say, well, we're probably going to come up with some kind of solution here. It's natural to get volatility in periods like this, especially after hitting so many record highs like we've seen over the last number of months. So we think this is just natural to go through a period like we are over the last few days. I saw the S&P is almost positive again today. So things are settling out. I think there's expectations that we'll come to some kind of agreements here on a lot of these issues that are at the forefront. And so when you strip all of that noise or headline risk away, what we're left with is actually quite a healthy market. You know, we have earnings growth that continues to accelerate. We have a jobs market that's okay. Interest rates seem to be stabilizing and coming down. And so we think that sets up really well into the end of the year and especially into Q1 of next year as we begin to lap some of the weaker data from last year. So we're encouraging our clients, investors to stay invested through this period, maybe use this as a period to pick away at some of the underperforming sectors or add exposures that maybe you were hoping that you could have added prior to this sell-off when things were going straight up.
Yeah, and some of those sectors have been really dragged down in the first part of the year. Are you seeing some of those revive?
Yeah, we are seeing some of them revive, but there's still a plethora of opportunities out there. So for us, a big chunk of where we spend our time is in small and mid caps and also in high quality equities. So in Canada in particular, high quality as a factor has had a pretty weak few quarters. And so there's a lot of opportunities there. Maybe we'll get into that during the show today that we're picking away at. And in small and mid caps, we think this environment that I just laid out for you, that sets up really well for, you know, the S&P 495 other companies outside of AI or even more value or cyclical based small and mid caps. So we've been having no trouble finding undervalued names with lots of catalysts, both in Canada and the US, that we think this sort of growth tailwind that's picking up in more stable inflationary and interest rate environment will help, and we'll see valuations expand there.
And you think AI will just continue to sort of bubble along in the background?
Yeah, we do. I mean, we're seeing contract after contract. Maybe there's overbuilding happening there. It's too early to say, but earnings growth has certainly been quite robust there. And so that's something that we're not afraid to be involved in through certain indices. If you own the NASDAQ, or if you own some maybe Canadian equities that are adjacent to that, or utilities or natural gas, which maybe we'll talk about today. So there's a lot of areas of the market that we're getting involved in because we think that's going to create a large tailwind. You know, we're not chasing some of the big momentum names, but there's definitely a lot of reality there. And there's a lot of contracts, a lot of earnings growth and CapEx spending that's going there that is real, and it is going to impact the earnings growth numbers in a positive way, which should be good for the market as a whole.
I'm sure you will get a question today from somebody who wants to know whether or not they should chase those big names still at the price it is today, but we can cross that road when we get to it. But People want to know. They still want to get some of the upside left in that lift. Okay, we're going to take a quick break. We'll line up some phone calls and some emails for James of Ewing Morris Co Investment Partners. Their questions today on North American stocks. We're back in just a moment. Stay tuned. Welcome back to Market Call. Let's go straight to an email from Val. Val says, hello, I would like the guest's opinion on buying J&J at the current valuation. We will pull up J&J and take a look at where it stands. How well do you know Johnson & Johnson? Yeah,
well, it's hard not to know. It's such a large cap company. Johnson & Johnson's had a great year. I think I was looking, he's up 25, 30% or so this year. So the valuation of Johnson & Johnson has expanded. And part of the reason for this is that they're shedding some of their lower growth businesses and really focusing on the med tech side and a lot of drug discovery in their business, which is a higher multiple business. So if they are successful in that growth, you could see the multiple continue to expand with a name like Johnson & Johnson. And when you think about the market as a whole, defensive stocks have actually been some of the weaker performers this year. Johnson & Johnson is typically held in that category. And so given the fact that they've outperformed that index, if you look at the min volatility index or things like that, it's really outperformed quite dramatically. So that's a really positive. So there's good things happening at Johnson & Johnson. We're seeing some spin outs, and they seem to have dealt with a lot of the issues they had on the legal side well. And so that overhang has been removed a little bit. So we don't own it. We would own it through ETFs and things of that nature. But if you were to hold Johnson & Johnson, I'd continue to hold it for the dividend growth there and for the potential upside from some of these new initiatives that they seem to be having success with.
Okay, good to know. Let's move on to a caller. Michael is on the line from Vancouver. Hi, Michael.
Hi there. My question today is on Facebook to Meta. I'm just wondering if that name change is a liability for shareholders also. Thank you.
So
was that Meta?
That was Meta?
Okay. Yeah, so Meta and all these names, a lot of these technology-based names have done quite well. Meta's been one of the laggards. So this would be one of those names in the high-quality bucket that I would think is going to start to catch up again and resurge. You'll see that multiple expand again. So I wouldn't so much worry about some of these names that are the largest tech names like the Metas or the Amazons that have been underperforming. We think there's a lot of positive momentum there in their business, especially with some of their Instagram and their Reels, and a lot of that marketing spend is starting to pick up again. Given my comments on the underlying economy at the moment, we would expect that to start to bleed into some of their business lines as well. So we would stick with a name like that if you continue to hold it. Again, we don't hold that name as an individual equity, but it is something that we think should do well in the next 12 months.
Okay, good for Meta. Let's move on to Carrie, who's calling from BC with a question. Hi, Carrie.
Hi, I'm phoning about. Thank you for taking my call, Marilla, and good morning, James. My call is about the Parkland Sunoco deal, and you have to make an election for the three options by the 17th of October. And I'm just wondering, what would your opinion be on those options if you know them?
Okay. Thank you for the question. Are you aware of the options of the deal?
Yeah, so this isn't something that I would have voted personally, but Parkland Fuels was a large name in our small cap fund run by my partner, John Ewing.
Okay.
There was some disappointment when this deal actually was announced in the multiple. It felt like it was something that was taken or was acquired at quite a low price. So Sunoco did quite well on this. So this would be a name that we'd be out of, or we would tender for cash if we could. And then you can reassess the situation after. This is typically how we treat a lot of these situations. Not always, but you want time to step back and reassess a new position and what that new exposure looks like. So I'd encourage you to take cash or to exit your shares as it gets closer to that takeover price. You do get some of these public shares, so it's a little bit volatile, right? You don't know what Sunoco share price could do or would do after this deal closes. So there's some risk there.
And when is the deal actually closing? Is there?
I'm not sure.
Okay, I'm not sure how long they had to act on that. Okay, let's go to JC on the line from North Bay in Ontario. JC, what's your question today?
Hi, I'd like to ask about Airboss of America. It was a pandemic darling that really came down. And with its exposure to defense, is there a lot of upside left in this one? It's still a slight fraction of where it was. I've got a very small position added recently. Do you think it's worth an add?
Okay, thank you for the question. What is Airboss? I'm not familiar with
Yeah, so Airboss is a name. It's a name that I would have talked about previously on Market Call over the years. We've been following it a long time. It's based in Waterloo, Ontario. So they make rubber compounds for tires, but they also make gas masks. They make overboots, overgloves, and a whole bunch of other rubber-type products. So they're one of the industry leaders, them and a company called Hexpool, which operates in North America as well. And so, so they won a whole bunch of contracts during the pandemic to provide PAPRs and all these tools that you needed to deal with that, which was a huge tailwind for them, generated a lot of cash. And since then, the multiples have come back as the focus has been more on, with all the military action that we've seen around the world, it's been more, sharp and pointy things versus safety and protection and equipment. But now we have an environment where countries are starting to spend more to build up their stockpiles, which have now been depleted. So things like gas masks or overboots, or they have a bandolier product that's been really successful with NATO countries. So absolutely, we believe that demand is going to pick up for Airboss. It's something we've been waiting for a long time, but these are large, chunky contracts that they have to win. And there's a lot of moving parts when you're dealing with, various governments and NATO to get these products through. So we're actually quite bullish on Airboss. We think the outlook for them is great. If they could ever sell and lease back this Waterloo property, which is on the market at the moment, that'd be a huge influx of cash for them as well to give them some optionality. So I'd certainly stick with Airboss at these levels and wait for some more positive news to come out.
So sorry, they're releasing a property that they now have to move and find a new property for their operations?
So they have a million square foot facility in Kitchener-Waterloo, right by the hospital, right by the main drag, if you know the area. So this could be a great area for redevelopment. I don't think the residents really want a big factory there that produces rubber. So it's a win-win if they can sell this property, maybe lease it back or move to a new state-of-the-art facility, which I believe they have plans for. So it could be if you look at Airboss in 5 years from now, it wouldn't be surprising to think that they're in a new location.
Okay. Let's get to a quick email before we take a break. David has written in, can I get your guest opinion on the short report on GoEasy? Is there any merit to it? Would now be a good entry price. We'll pull up GoEasy and have a look at where it lands today. What's your opinion of GoEasy?
Yeah, so GoEasy is a name we're quite familiar with. It's one of the first stocks I bought with my partner going way back into 2013, 2014. So we've been following it for a long time, and we've thought this run that they've had has been quite impressive. They've done a really great job of building out the business, upgrading their loan portfolio, adding new adjacent businesses. But what you have to recognize with a lot of these financial services companies is that it's extremely complicated. And so it's really hard to get your hands around what's actually happening under the hood. And you really have to put a lot of faith in the numbers that you see from management because you can't really prove or disprove them. And so this short report really highlighted that. And that's a big reason why we don't get into these complex companies that use their balance sheet to finance certain things, especially an alternative lender like this. It's something we've really shied away from because of the complexities of the business. So, despite the fact that the stock price is down where it is from, it was trading in the 200s, I think it's down at 160 now. The multiple is still full and where there's no way of disproving or proving that short report. So we'd be on the sidelines for it. It's not something that we'd prefer to chase at these levels. There's lots of better opportunities that we see in the market.
Okay. We're going to take a break. James Telfser of Ewing Morris Co Investment is our guest today. He's taking your questions on North American stocks. Here's how to reach us. Back in a moment. Welcome back to Market Call. Perry's on the line in Toronto with a question today. So let's go live to him. Perry, what's your question today?
Yes, thank you for taking my phone. I just wanted to know what happened to Brookfield. The one is BN. Thank you very much, because all of a sudden from $94 came to 60-something. I appreciate it. Have a good day.
Thank you for the question. So it is down to 63.48. It's up a little bit today, actually. It's doing well. But was there a trigger for the stock dropping?
There's been some corporate actions that have happened with Brookfield. I don't know all of the details. It's not a stock that we own, but I would encourage you to look wherever you view your stock to find that corporate action to see what's happening. The stock has not dropped that much. There's just been some, they have all their structures that they're trying to clean up, and that's why the stock will be down so much.
Was there a stock split?
I don't believe it was a stock split. I think it was a corporate action with one of their other entities that was the same as Brookfield Corp.
Got it. Okay. So you think it's going to readjust essentially? Is that not actually down in the 60s?
Well, what happens with a corporate action is sometimes the stock price on whatever system you're using, it shows a large drop in the actual chart. But if it's a spin out or if it's a stock split, then it'll catch up eventually, and everything adjusts down to that lower level and adjusts backwards. So it looks alarming when you see it, but it's typically because of a corporate action, and that'll get fixed with whatever system that you're looking at.
Okay, so is she best to hang on to the stock and sort of just wait out this ride?
100%. Just wait. If you held, for the reasons you held Brookfield yesterday, should be the same as today. I wish I knew more about this corporate action.
Sure.
I wasn't following it that closely, but if you held Brookfield Corp yesterday because you wanted to participate in alternatives and in infrastructure and in their asset management fees, all of that still exists today. You just have maybe a different entity that you're owning it through, which is why it shows that drop in shares.
All right, good information to know. Let's move on to Nazar, who's calling from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. I James. May I have your thoughts on Bank of Nova Scotia, please? It has recovered very well and pays a good dividend. Would you continue to hold it? And may I have your thoughts on Canadian banks in general, please? Thanks for taking my call.
Okay, so let's start with Scotiabank, which is up 24% on the year, moving up a little bit today. It's at 89.74. Let me start wider. What's your take on sort of banking in general in Canada, the big banks, we'll say?
Yeah, sure. I mean, it was a sluggish. This year is great. It's one of those years for the Canadian banks where, you remember why everybody holds the Canadian banks, and you're always told don't sell some of these Canadian banks. They typically tend to bounce back after periods of sluggishness, or if the multiple compresses, it typically will expand again. We have a great industry for Canadian banks, and now we have an outlook that looks a little bit more rosy than it did, which is hard to imagine, but it's a little bit more rosy than it was maybe 6 or 12 months ago, because we've seen some of these provision for credit losses have started to come in. We're seeing the investment banking side of the business pick up. Of course, when markets are trading near all-time highs, and gold companies are doing well, there's a lot of levers that these banks can pull to earn higher, to earn more income on their capital base. And so we expect that to continue as we look out to the rest of the year. So we would continue to hold on to the banks. I wouldn't really, zero out Bank of Nova Scotia. It's performing well because everything else it seems to be performing well. For us, a bank like Royal Bank is one that we hold for almost all of our clients across the board, and we haven't trimmed that position in many, many years. In fact, we add to those positions when they sell off, like we've seen over the last few years. So we would just continue to hold the banks. I think Bank of Nova Scotia should do fine. They're going through more of an operational turnaround. So similar to TD Bank last year, when they've started to rebound from that, there could be more upside with the Bank of Nova Scotia if you look out and they're successful in all of the different levers they're trying to pull within their business, cleaning up South America and getting into.
You made a good point. Do some of them have a little bit more room to grow than your RBCs, for example? TD came back from that ding in the U.S., so it sank and now has more room to grow. You said maybe Scotiabank does as well.
Yeah, I mean, if you go back over long periods of time, if you buy the Canadian bank that is trading at the lowest multiple, it typically recovers back to the average or the mean of the Canadian banks. And so Bank of Nova Scotia would be in that bucket right now of an underperformer relative to the other banks. We would expect that to pick up at some point in the future. For us, we just prefer to hold one of the higher quality names and just ride out all the ups and downs versus trying to switch between banks to get a little bit of extra alpha. We're concentrated. We hold high quality, which is why we do it that way.
Okay. All right. Let's get to John on the line. He's calling from London. Hi, John.
Hi, Marilla. Hello, James. Brookfield bought the rest of Oaktree. I'm not sure if they're spinning that out, and that's accounting for some of the drop, although Oaktree's only worth about $9 billion. Stay tuned, I guess. My question's on Exchange Income Fund. Canadian stock's done well, pays a dividend. It's sort of languishing a little bit now. I was thinking of holding it, or maybe a small ad, and keeping it for the next 2 to 3 years. Thanks very much.
Okay, thank you for the question.
Yeah, thanks for trying to provide some more clarity on that. I wish I knew more about that Brookfield situation to help. But yeah, with Exchange Income Corp, this is, it's really, if you zoom out even further on that chart over 5 or 10 years, it's actually been quite the compounder. It's sort of a sleepy compounder. I don't hear of a lot of portfolio managers or see a lot of investor portfolios that are transferred into Ewing Morris have a position in this, but it's one that we've held for a very long period of time. And it's just been, they expand by they got into matting. So if you're a utility and you're expanding and you need these mats, they got into a company that builds the outside of apartment buildings or commercial buildings with all the windows. They own a lot of these helicopter contracts for emergency services in remote areas. They own the airline that will fly you to these remote areas if you need to go somewhere remote from Calgary or Manitoba. So they've got a lot of different businesses that they don't always work together in ways that are synergistic, but the way that they think about the business is much like a private equity type mindset, where they're buying companies when they're very undervalued. They see free cash flow coming from that business, which will help them deploy that cash flow into other areas of their business or make other acquisitions. And so they're just clicking, they're firing on all cylinders right now. I don't see a reason why I would run for the exits on a name like this. I would continue to hold it, clip that dividend yield that they get and see if that multiple, can finally expand beyond where it is today, because it's always traded at a discount to a lot of their peers. And so, yeah, we think the outlook's pretty bright for them at the moment.
Okay, we are going to take another quick break. We will take a look at James's past picks when we come back. Welcome back. Time now for a look at past picks from April 15th of 2024. Is that right? Was last year April 15th?
Yeah, it's been
a while.
Okay. I've gone through some things. Yeah.
I was going to say. So let's take a look at what you chose at that time. It was MDA Space at the top. At the time, it was $14.31. And a lot has happened for this company since you recommended it. It's now at $36.08. So it's 152% up from April 2024. Same for total return. They actually lost a key contract that cost them, meaning investors took it out on them. The stock sort of sank because of that, and it's come back a little. Do you still like MDA Space?
I do a lot. We exited the name a little bit higher than here, actually, but we exited the name because we just thought the valuation was full. When I go back to when April 14th, James, when I recommended the stock, it was still like very cheap. Like it was trading at a single-digit PE multiple. Okay. Nobody was really talking about it, but they started to build this backlog up. You started to hear more and more about, various large tech companies that were going to MDA Space to produce satellites. So there was something. It was there, and now, of course, we've seen billions of dollars added to their backlog over the years, we all know about SpaceX, and all know about all these players now that are really trying to take advantage of this lower Earth orbit and get a bunch of satellites up there for broadband and other uses. Like the telcos are in there, everybody's in that space now, and so they've really benefited from that. And we've seen the multiple expand to a level that we think is reasonable in the mid 30s here. It just looked a little frothy to us when we went from $20 to $40 very, very quickly, so we exited it. If the stock continued to be weak, or maybe they lose another contract and it dropped back into the 20s again to a level that the valuation looked a little bit more appealing, that's something we would likely look at again. I know our two portfolio managers on the Canadian and U.S. small cap side, they like the satellite space quite a bit. There's a name called GoGo in the U.S. that they're involved in that does internet on planes, that pings off. So there's a lot of cool areas in that market. We like that theme a lot.
Okay. And that's MDA Space. Let's get to your next past pick from April of last year, Microsoft. At the time, it was $413 US. It's up to $509.33, a return of 23%, a total return of 24%. We talked a little bit at the start of the show about these tech names that have just been sort of running wild, and whether or not you would still invest in it at where it is today. Is this something you remain invested in? Did you trim it all? Would you recommend it today?
Yeah, I remember making this pick thinking that's really boring to pick Microsoft. But, it did well. It did exactly as it should over that period, maybe a little weaker than I would have thought it would have performed. But if you step back on a lot of these names and you look at it's not like Microsoft's expected to grow their earnings by 50% or something like that, but it's just a very steady 10 to 15% earnings growth. A lot of that flows through to free cash flow. They can easily fund a lot of this build out. And they're having a capacity issue. They can't actually build fast enough to get the GPUs out there that they need to support their business and grow. So that might actually be a bit of an issue. They could get, they could hit the ceiling there in the short term. But this is still a company that's growing their Azure business by almost 40% year over year. And I remember talking about this years ago, that they were growing north of 30% or 30 to 50% in that business. So it's quite impressive. And the multiple is certainly not demanding for that type of growth. I would say for that type of growth, it's actually still undervalued. So, any weakness in a stock like that, looking out for the next couple of years, we would still be buyers of it.
Okay, let's get to ARC Resources, your pick from April 2024. $25.19 at the time and $25.57 today, so a return of 2%, total return of 6%. They are a national gas player. We have a lot of people who like the stock. They think it's one that's going to, be more involved in the gas play sort of in the years to come, now that we can get our gas sort of to other countries off the West Coast, and that build out continues. They think companies like this could benefit. But there's still pressure on the price of natural gas.
Yeah.
And what do you anticipate moving forward in this space?
Yeah, it's still a cyclical industry. There's a lot of moving parts. Just because we've got one of these facilities up and running, it doesn't mean all of a sudden, magic wand, you have prices that are doubled where they were in Canada on the ACO price. But it's coming. That's going to happen. We see too many tailwinds in that business for pricing not to firm up there. And we think ARC Resources will be a big beneficiary of that. And so, if you closed your eyes and you kind of looked at your portfolio again in 28, 29, in a few years from now, I think you'll do quite well on names like this if it's still a public company. The free cash flow projections at very undemanding forward strip are quite high, like very high, like, in the mid-teen %. And so if you compare that to any other company that's out there, like that's very attractive for a high quality business like this with a great management team. And so, ARC Resources is a name that we would continue to recommend. And if you stick around to the end of the show, it's probably not surprising. There's another high quality natural gas player that I'll probably be recommending, but similar to ARC Resources, we really like that play. And with data centers, and you saw some of these announcements like with Meta and Pembina, and
everybody needs the energy.
There's a lot of demand for natural gas, and you're not seeing. You can't build out the nuclear side fast enough to really support that. So the demand here is likely here to stay. It's just a matter of time before that shows up in the price.
Okay. James is going to stick around and answer more of your questions when we come back. Stay tuned. Welcome back to Market Call. Thanks for joining us today. George is holding on the line, and he's in Toronto with a question today for James. Hi, George.
Hello. Thank you very much for taking my call. Good day. My question is, can you comment on Loblaws, particularly since the stock split? I noticed that it kind of dipped, and I don't really understand what happened there. And the question is the class action suit against both the bread issue with Loblaws have anything to do with it, and what are the prospects for Loblaws going forward?
Thank you for the question. I feel like the bread fixing issue is sort of sailed.
It's certainly built in at this point. It's something that's pretty well known by investors. I don't know exactly if there's a specific date coming up on that might impact things, but I wouldn't be focused too much on that at the moment. The outlook for Loblaws, if you think about, the business has done exceptionally well over a period of time as we saw food inflation. A lot of that sticky inflation that tends to stick around has been very healthy for the margins of a lot of the grocers. But, inherently this is a defensive type business that you want to hold as a, sort of a core defensive name in your portfolio. I don't think there's anything wrong with that. I don't think it's particularly overvalued given all the franchises that you're getting in Canada with Loblaws and Shoppers and the land that they have and the retail side of things. But, for us, for that type of exposure, we've actually been pivoting to names like Couche-Tard as a potential addition to portfolios.
Which has been beaten down quite a bit because of the attempts to sort of take over from a Japanese company.
It has been beaten down. There was a lot of spending that was going to happen there and some uncertainty about the price. And so now you're seeing a slow recovery in that. And if you've followed Couche-Tard over the last year or so, it's kind of been the opposite of Loblaws, where they've struggled to beat expectations. So if you look at the next 12 months, if I was to hold the two of those names side by side and have to place a wager on which one is going to exceed expectations, I would probably bet on Couche-Tard, which is what we're doing in our portfolios. And so we think that we'll see a multiple expansion there as that stock is really checked up for, the better part of 12 months as all of this has been happening with Couche-Tard. And gas prices have been, settling, but I think margins are going to be still okay, and that should benefit their convenience store business. So there's a lot of positives on the Couche-Tard side, and the valuation seems right at these levels. So I'd encourage you to maybe, if you're active in your portfolio or looking for a new name in your portfolio, that would be somewhere I would look before adding more to Loblaws.
Okay. George, hope that helps you make any decisions. Let's move to Greg, who's calling from Winnipeg. Hi, Greg.
Good morning. I recently bought Lightspeed because of its low price compared to its earnings. Would you give me your outlook on the stock, and could it return to past levels? Thank you.
Thank you for the question, Greg. Pulling up Lightspeed now. It's at $15.95. It's up a little bit today, 3%. Or 49 cents, but down over the year 27%. What's your take?
Yeah, so Lightspeed was a tech darling at one point here. It was sort of competed in that area of getting into the consumers, having a system, getting into a consumer retail location, getting the system in place there to really handle the billing, the technology side of that business, and expanding from there. It's just been a real struggle for Lightspeed. I see when you look at the long-term chart, it doesn't really look like there's much reason to be optimistic there. There's been some, activism. There's been some takeover rumors. There's been all of these things, but nothing has really come to fruition there for Lightspeed. So typically with a name like that, you want to see a few quarters of positive momentum. It's good to be, you never want to be too early on a big turnaround like this if it is going to turn around.
Did they lose a lot of competition? Is that what happened?
Lots of, once you start really struggling in that business, it's hyper competitive. And so if your stock goes down 50%, your competitors are going to start to point to that. You have a lot of management change and turnover in there. So morale's not great within the organization. So I would wait a few quarters for things to start looking like they're improving, if that does happen, before getting involved in a company like this. It's likely cheap relative to what they are, but I think that's not always a good reason to invest in our view.
All right, let's get to Cole, who's calling us today from Newfoundland with a question. Hi, Cole.
Hey, thanks for taking my call. I'm 19 and I hold G Mining, Barrick, and some gold via GLD in my TFSA. Are these positions overlapping too much? And what are some good ways to play gold and mining stocks right now? Thanks.
I am shocked at how much he knows at the age of 19. He's rhyming things off left, right, and center. So is there such a thing as an overposition in gold?
Yeah, well, if you take a step back and you look at we call it a modern endowment model that we manage at Ewing Morris, we have sort of a 5 to 10% weight in gold, depending on the risk tolerance or gold mining names in the portfolio. But it's mostly just owning GLD. But it certainly wouldn't be 50% of a portfolio. We'd be hard pressed to push that beyond 10%. So from a portfolio management perspective, you want to be much more diversified than having 3 or 4 names in your portfolio. Now, if you had that positioning at the beginning of the year, you're in a really good position now to rebalance. And I would encourage an investor to do so at this point, to rebalance a little bit of your portfolio, since you've made so much in these gold names, presumably. And from there, you could look at various equities, allocate to the U.S. We're quite bullish on the U.S. dollar at the moment, so maybe adding some U.S. exposure to your portfolio through your TFSA that will benefit you. Stick to large ETFs if it's not a lot of money in the portfolio. But I don't think you're going to get. You're not going to hurt yourself by continuing to hold that GLD position. But some of these gold mining names, they're kind of waving in the wind here. We've had a pretty big rally here in these names, and it wouldn't be surprising for us to hear some news in the next couple months that knocks that rally onto its butt a little bit. And so
maybe consider trimming.
Yeah, when things feel like they have nowhere to go but up, that's usually a good time to take some money off the table, which is certainly what we'd be doing here as portfolio managers of those positions.
All right, let's take a quick break. We're going to come back with James, who's answering your questions on North American stocks. Back in a moment. Welcome back. Thanks for joining us on Market Call. Glenn is on the line. He is in Toronto, and he's got a question today for James. Hi, Glenn.
For taking my call. I would like to know about Americold Realty. They've been trading for the last 8 years, and they're at a low. I want to know the factors of why it's low at this price. Is it electricity price, or is it volumes and storage? And do you think this would be a stock to add to a portfolio at this point?
Thank you for the question. So this is a company that does cold storage.
Yep.
Is there any reason you see for this drop in the stock?
Yeah, well, I think when we've talked about this internally as a team, you look at a company like this, which is a REIT, right? Like it's a name involved in real estate. And so when you want to own real estate in your portfolio, that's not the sort of chart that you want to see. And I think it's probably caught a lot of individual investors and institutional investors off guard. Pricing was really firm throughout, the pandemic years, really. And you saw, big demand, volume growth was there, pricing growth was there. It's hard to build these things. There's not a lot of them. There's a logistical element to it. But then you've seen prices really start to fall off, and it hasn't really stopped yet. And, inventory builds are happening, and things aren't moving around as much as they were. And so you're seeing that large multiple that got priced in when things were going,
Well.
bottom left to the top right. Now that multiple is starting to come back in line. And it's most definitely overcorrected here. So from a contrarian play, there's probably is some upside in this, and we should see this rebound. They're hard assets to replicate and to replace. So I wouldn't be so worried about the long-term fundamentals of the business. But I guess it begs the question, if you're looking for a real estate play, is there something better that you can do with maybe more predictability, with some more stable pricing? And for us, a name that we've been adding to is Minto, which is a Canadian REIT. So there's some benefits there in owning a Canadian name. And for us, we think that's another name that's really struggled. It's trading at a large discount to its net asset value, but it's easier to explain. We can see that rebound happening there in the next few years because these are very hard assets to build now. And as you know, we're going to be going through a period where there will be no new builds coming out in like 2027, 2028, and you should see some of these rents with a name like Minto, as they rent units out, start to firm up a little bit. And again, this is also a name that we wouldn't be surprised if it's taken private again, because Minto was IPO'd to really benefit the family that was doing all of the development work and then selling them into this public REIT. So we see a lot of optionality and catalyst there. So just maybe an interesting name to look at side by side with Americold. Very different, but still real estate related.
Okay, let's go to Linda. She's on the line in Montreal. Hi, Linda.
Hi. I'd like his opinion on Algoma Steel. I hold it on the Canadian side, and it took a huge beating with those tariff announcements. Does he see any upside coming soon on this one?
How long have you held it, if you don't mind me asking?
I've held it for about 2-3 months. I didn't buy it at that high, but I am losing on it.
Okay, thanks for the question, Linda. Algoma, of course, hit by the steel tariffs, 50% going to the U.S. They are benefiting from a government financing to help them out. Yeah. But is that enough for a recovery of shares?
Since Linda and my portfolio manager, Anthony, they're sort of kindred. They like the pain of names like this. So when I ask Anthony, who runs our Dark Horse Fund, what's a name that's most interesting to you at the moment? And
he would say Algoma.
He would say Algoma Steel, and it is a name that we own a little bit of. And he would say that, Algoma Steel is either going to be north of $10 or it's going to be $1. I don't really know where it's going to go, but something's going to happen there. It won't be at this particular price. And so this story is far from played out. But if there's a company that can maybe handle being the steel producer for Canada in various regions and different products, Algoma would be one of those companies that could supply that. So that could be beneficial. Or if we see something happen on the Canada-US front, and things open up again, then that could open up, a whole, have a resurgence of that market for Algoma Steel, see price recovery and all of that. So, but this is a company that's got, balance sheet issues. This is why they're looking for debt. Our opinion on that was that this was a reasonable deal for them. So not a, super dilutive to shareholders. So it'll be really interesting to see how this plays out, but it's going to be really hard to predict where it goes. So
and how long it'll take.
So it's one of those names where you just you have to buckle up. Don't make it a massive weight in your portfolio. But if it's a name and a company and a story you're engaged in, there could be upside here for sure, but there could be lots of downside. So make sure that it's risk capital.
Okay, let's move on to Bob quickly from Kitchener, Ontario. Hi, Bob.
Hi, listen, thank you for taking my call. I'm a long-time holder of Curaleaf Holdings, and I just like James's take on what he thinks of that company.
Yeah. No, I was wondering if any of these, years ago, it was all cannabis, and it's been really quiet on that front now. It's a super interesting sector. So, two key themes for us in our Canadian small mid-cap fund would be natural gas and weed stocks. And, the sector as a whole has really improved. Sure. And nobody's really paying attention to this. They're
doing a lot of export now, right?
Yeah, a lot of export, which is really, really valuable for them. But balance sheets are cleaned up. They're more rational, better management teams in place. Nobody's running out buying things anymore, like crazy and paying these wild multiples. So this is just natural for a sector to go through an evolution like this. And it can be really interesting if you get in when things are starting to inflect higher with some rational thinking, maybe paying some free cash flow back to shareholders, maybe making a smart acquisition to get better scale. So there's a lot of interesting things happening here. And for us, one of the key metrics is who's talking about this? Are you seeing, this stuff come in your from your sell side notes into your email every day? It's like one broker who covers it. So there's still a lot of room for this sector to gain more attention. Now, it's going to be volatile. It's cyclical. It's still a commodity type play. So you have to,
again,
buckle in a little bit.
Up and down.
But if you're into finding things that are undervalued in an industry that could be improving, it's an interesting area to stay. So I'd hold on to that as my long-winded way of saying that. Yeah.
We are going to take a quick break. We're going to have James's new top picks when we come back. Join us tomorrow for Market Call. Chris Loomis on the show. He's portfolio manager at Raymond James Investment Counsel. He'll take your questions on North American large caps. And time now for top picks from our guest today. We are going to start with your first pick, James, which is Tourmaline Oil. You touched on it a little bit earlier today because it's the same play as ARC Resources.
Yep.
And why do you like Tourmaline, and are you investing in both?
We do have an investment in both, but Tourmaline would be our largest position in our Dark Horse fund, which is our Canadian small cap fund. We've been adding to that position. The stock price has been, somewhat weak over the last number of months, partly because of natural gas prices, pulling back a little bit, but also partly because, there's a bit of a newfound bend towards growth with Mike Rose and the company. And so I think investors have been conditioned in this space, in the energy space in general, as Canadians, that you're going to get a whole bunch of capital back, a lot of special dividends, free cash flows coming back by share buybacks. So when you start talking about spending a little bit more money to prepare yourself for the future, shareholders now need to be conditioned that that's not a bad thing. But for us, that provides an opportunity for us to get even more involved in a name. So over time, doing this long enough that there's only a dozen CEOs that you can always count on to do the right thing for shareholders, and Mike Rose here would be one of them. And so we just think he's positioning the business to take advantage of some of these growth opportunities they have on their existing land, to position themselves better for more LNG demand, for more data center demand, for more maybe coal to gas conversions that are happening in Canada. So there's a lot of positive tailwinds here, and so close your eyes. Look at your portfolio in a few years from now. I think you'll be pretty happy that they made these investments in the business. And the balance sheet's phenomenal. So if this stuff works out as well as we think it will, there will be more buybacks. There'll be more special dividends down the road. And so we think the stock's still too cheap for what could probably be delivered, with a high probability for us, at least in the next few years. So we'd be buyers here.
That's Tourmaline, TOU on the TSX. Let's get to your next pick, which is Driven Brands, so auto services, essentially. Yep. What do you like about what they do? Yeah, so this is a name, we have a U.S. fund that we focus there on interesting ideas, and Driven Brands would be one of our top positions there in that fund. So you're right, it's sort of consumer, commercial auto services. So think about things like quick lubes or maybe auto glass or car washes, but the real great part of their business is this quick lube business called Take 5. And it's such a brilliant and such a great business because every car after a certain amount of kilometers, 5,000 or so, or 5,000 miles, has to get an oil change. Sure. And so you have a number of options when you're looking around for an oil change. You could go to your dealer, you could do it yourself, maybe, I guess. Some people do that. Or you can go to one of these quick lube services. And it's usually cheaper. You can usually sit in your car. It's usually faster serviced, I said quicker, but you get the point. So you have to drive by all these other services if you're going to go there before you get to one of these. So we just think the demand in that type of business is going to be recession proof, and it's going to continue to grow over time. And they're going to continue to open up more locations and be a formidable player in that space. They're currently number 3. And so what's been dogging the stock is just having all these other divisions that clouds this great story. And so we believe the management team gets the message. They will be divesting certain businesses to be more of a pure play, quick lube business. And if that happens, it'll trade much more similar to a Valvoline, which trades at a higher multiple and gets a lot of institutional investor interest. And so we just think it's a great time to look at the name. They've got a heavy balance sheet at the moment, but if they sell some of these things,
they'll pay down the debt. They'll become more of a pure play. The multiple should expand, and it'll be on its way. So great business and a great sector.
Got about a minute left, so let's get to Aecon. No problem. ARE on the TSX, a construction company, which could benefit, I guess, from the Canadian infrastructure build-out plan.
Oh, Canada, North America, globally. This is there's a lot going on in that construction and infrastructure space. And so we think Aecon's going to really benefit from that. But when you look at Aecon versus their peers, they're still trading at a significantly lower multiple. We believe that's going to slowly over time increase as we get rid of some of these large cost overrun projects that they have. The Eglinton LRT is starting to, they're in the testing phase. That's one of the big ones. There's a couple other ones that should get resolved in the next 12 months or so. And so once you get rid of the headaches or the overhangs on this stock, we think that multiple is going to start to expand and just in time for some of these large infrastructure projects and nuclear energy. Once that starts to go here, and Ontario is at the forefront of this globally, which is pretty awesome. And so, Aecon should be a beneficiary of that down the road as well. So we just think the stars are aligning here for a great few years for Aecon, from a free cash flow, from a multiple of growth, and from an investor interest standpoint.
And both those stocks, the last two, are pushed down a bit, so it might be a good time to pick it up. Got to leave it there. James, thank you so much for joining us. Appreciate that. Thank you for watching us on Market Call. We'll see you again tomorrow.